Dear students, welcome back. So when we appraise different projects in finance, an important part of this appraisal is to understand and analyze what will be the impact on the outcome of the project if you make some changes on the inputs. So for example, if we take a look at this NPV project over here, net present value project over here, there are two main assumptions that are there in this project over here. So again, let's read through this table and what the content is. So the top line is periods listed. Period 0, that is the starting point of the project. Uh, say year 1, 2, 3, and 4. And cash flow at the starting was 50,000 that you put in. And afterwards, every year it was generating 20,000 of a positive cash flow coming into your business, say, during this project. And one of our key main assumption was discount factor. Say it has been set at 10%, and then based on the calculations, this is what we have got it as and time went on. So yeah, starting point year zero, it was 1%, or yeah, one, which is 10%, and then as time proceeded, year 1, year 2, year 3, and year 4, these are the values. And based on that, yeah, like for the very first, the present value was negative 50,000, because at starting point, this is the amount that you put in. And from year 1, 2, 3, 4, like yeah, these were the cash flows, and the equivalent were, yeah, cash flow multiplied by your discount factor. So these are the numbers. And finally, at the end of fourth year, you are getting 13,397. So as per, yeah, all these calculations, this is what we are getting. So let's look into a little bit more detail. So first on this, the discount count factor, we are going to start at 10%. So that's the very first assumption. And the second one on this is that the annual cash flow starting from year 1, after 1 year, is going to be 20,000 per annum. So yeah, 1, 2, 3, 4, 20,000 each. But as the project will be executed in future, these value may change due to several internal as well as external factors. Yeah. And we have to analyze the impact of these changes right from the beginning, so that we can take some decisions accordingly in a timely manner. Now this is called as what if analysis. Yeah, so you have to do some systematic analysis. Yeah, like you do some logical thinking, add some numbers, and in future what will be the effect. And you have to always have to think about best case scenario, worst case scenario, and among those, what if analysis is a very commonly used scenario in industry. And this is, I will say, in this stage of your career, very important skill to have. So now this is called as the what if analysis. And the best part about Microsoft Excel is that it has given a complete tool of what is analysis. Yeah. So for that, you see, I will go to this data tab over here. And here is the sub tab where it has the systematic analysis listed. And among those, if I make this arrow bigger, there are three different scenarios. Yeah. So in today's class, we are going to learn all these three scenarios. But at first, we'll be starting with the goal seek part. So yeah, let's go ahead with that. So yeah, now let's take a quick look at the table. So let us see. In fact, you can see here that the NPV of the project, if you go by standard practice, it's going to be 13,397. These are based on all the calculations you've done in the last 4 assignments. Now we want this, suppose, yeah, like in a long term, if I'm doing the planning for my business or my project I'm working for, and if I want this NPV to be, say, $20,000 over here, yeah, and currently, as per my, if I keep everything same for 4 periods, cash flow of, first, like at the starting point, yeah, times 0, I'm putting in $50,000, and every year I'm getting a positive cash flow of $20,000. And based on the discount factor and all those internal external factors, inflation, deflation, and so many, yeah, depreciation charges and so on, the actual amount after 4 years is going to be 13,397 based on the calculations. Now, say if I want to create a scenario where I want this to be 20,000, yeah, then you can simply do that by trial and error method. That is, see, there are three factors over here. Yeah, first one is period, cash flow, and discount. The very first factor I would like to try is say 10%. See, let's see, if I change this to 11%, what happens? And again, my goal here is to achieve an NPV of 20,000. So if I go here and just say delete everything and put 11%, oops, sorry, 11%, it's yeah, looks like it's decreasing. So that's not a direction I want. So initially it was 30,397, now it's 12,000. So if I increase the discount factor, it's decreasing. Yeah. So let me put say 9% over here and see. Yeah. So this is increasing 40,794, almost 40,800. If I make this as 7%, yes, I'm headed in the right direction. My trial and error is moved going in the right direction. So if I put 6%, 19,300 is getting closer to 20,000. If I put 5%, it's more than 20,900. So looks like the answer is somewhere in between 5 and 6%. So I will just do some random things. So 5.5. Wow, yeah, so 5.5 is taking me very close to 20,000. So maybe I will try to play with some precision level, say 5.51 gives me 20,000. Let me play with 5.52, getting closer. If I do 5.55, 20,000, and see if I do 5.56. Yeah, very close. In fact, it's still more. So maybe 5.562, yeah, getting closer. 5.564. Oops, maybe it's overboard. 5.55. Yeah, maybe somewhere over here. Yeah. So you see how much time I spent wasted, and yeah, I got a number that is close to 20,000. The best part is that Excel has this all listed very well. And yeah, we can systematically use this what if analysis and complete this. Yeah, so let's go ahead and yeah, I'll just do Control Z, 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 and let's get back to our most basic problem that was given. Yeah, here we were. So yeah, let's start with the what if analysis using Excel. So very first is I'm going to elaborate this and going to say goal seek. I'm going to select it. The very first cell it is asking me is what cells shall I set? So I'm looking at this E9. So I should be selecting E9 over here. So just go over there, E9, come back. And I want this E9 to be set at 20,000 by changing with cell. Yeah. So in this case, I know my discount factor is what I'm looking to change. So I'll select this. And yeah, everything looks correct. Now I'm going to click OK. Awesome. Yeah. So you see Excel auto calculated and ran the what if scenario. Yeah. And while doing so in the video, you can see there are a few iterations it played, and eventually it gave me this NPV of 20,000, which I'm looking for. And it will take a discount factor rate of 5.56 to achieve that in 4 years. Yeah. So this is the first way. So you can see how easy it is. And again, as of now, if you haven't used any financial statement of or financial analysis, this might be a new information for you. But this is one of the most commonly used function in financial world. So if you get a job in future, or if you're looking for a career in financial analyst, and again, as you grow through, there are lots and lots of job positions that will require this one of the most basic skill. So it is one of a good skill to know, understand, and learn as soon as possible. And I'm sure as you move on, take more financial classes, you will learn more about it. But again, yeah, like as a part of this class, I'm just trying to show how Excel has this inbuilt, and you can easily learn through all this trial and error and save a lot of time and get a very accurate answer. So yeah, that was the very first. That is, yeah, by changing the discount factor, you get the net present value. Yeah. So suppose there is another scenario you're looking at. Yeah. So in this case, in the very first case, we tried to change the discount factor and get a net present value of 20,000. Suppose now your goal is to keep the discount factor same as 10% and play with the cash flow and same time period, that is 4 years, and you still want to get the net present value NPV of 20,000 from 13,397 to 20,000. So yeah, we can do that as well using the same type of analysis. And for that, I will say, yeah, let's scroll down. And again, I have listed the same thing. The one thing is, while doing this what if analysis, yeah, you can't do all the three analyses at once. Yeah, that's how it is. Only you can do only one thing. Yeah, one change at a time. And in this case, since you are only trying to change the cash flow over here, which is same for the next 4 years, you can only do it for the last time period. So number 4. So that's what I did over here. I only copied the time period 4, and all the numbers are the same. And let's try and solve the same problem using what if analysis. So again, the goal is the same. I want my NPV to be 20,000, keeping the discount factor same and time period same at 20%, and by changing the cash flow. So let's go ahead and do that. Again, this can also be done using the trial and error method, but again, it will take me a lot of time, or anybody a lot of time. So thanks to Excel, it has this formula inbuilt. So I'll again go to what if analysis. I will go to goal seek, and here as well, yeah, this is already selected. So I'll select E26, and dollar kind of fixes it, which is okay. Yeah. The next one is I want this to set this value to 20,000. Which I did, and then by changing with cell, so this time I'm selecting the cell C25 and dollar, I have fixed it out, and then let me click OK. And while doing so, it did its trial and error repeated iterations, and it is telling me that in order for me to achieve a net present value by changing the cash flow, I want the cash flow in each of the 4 years, year 1, 2, 3, 4, to be $22,083 to achieve a net present value of 20,000. Yeah, so that's the second way of doing it. And now the third one is, suppose in this main problem over here, I want to keep the discount factor as same 10%. I want to keep the cash flow same as 20,000. And I want to know that how many, if I want to achieve a net present value of 20,000 years, how many years will it take to achieve that? So yeah, like I said, Excel can only do it one factor at a time. So if you scroll a bit down, bit more down, and like I have copy pasted, and again we have to just do it on the final time period. So again, the goal is the same, to achieve a net present value of 20,000, keeping the discount factor same, keeping the cash flow same, and changing the time period. So let's go to this what if analysis. I will select goal seek out here, and select this. I'll set the to value as 20,000. By changing the cell is B38. Yeah, looks correct to me. I'm clicking OK, and you can see it did its iteration. And Excel is telling me it will take me 4.52 years to achieve a net present value of 20,000 if I keep my discount factor as 10% and cash flow as 20,000. Yeah. So this is how you utilize the what if analysis and the goal seek part of the what if analysis to run the different scenarios. Indirectly, it is a tool that will help you eliminate the trial and error, and within few clicks and few seconds, you will be able to get these answers. And these are some of the most commonly used for financial analysis in financial world. Eventually, like we'll be solving one assignment using this what if analysis. And again, we are preparing for one of the last assignment which is coming, which will be our next big assignment that will be taught on Wednesday. And eventually, I'll be sending out the information about what you must include in your resume based on this analysis you have learned about how to use Excel for financial analysis and financial statements, which should help you, guys, earn some good credentials, good skill sets, and who knows, some good jobs as well as internships. Okay, so let us do some more practice of the goal seek function here. And a more detailed scenario is shown out here in this table. So I'll make the screen bigger. Yeah, this looks good. So here you can see, suppose you have an initial investment, or your company employer has an initial investment on a project or a facility starting. So the initial investment amount is say $2 million. The sales unit in year one, the first year was say 40,000 units, and you expect a sales growth year on year at 8% level. Suppose the sale price per unit sold is say $10, and among those the outgoing cost, so the sale price is say $10, and the cost of sales is 25%. Administrative expenses are say 20%, and say marketing expenses are 30%. So together these three they cumulatively they contribute for like 75% out here. So that tells me that the remaining 25% is your net profit. So these are the initial conditions given to you. And suppose if I do some more P and L analysis, which is nothing but profit and loss analysis, which is a very commonly used term. Yeah, so again, based on the year one, year two, year three, and year four, I expect yeah all these initial investment to be paid off, and these are the expected sales. Yeah, the sales amount per year based on the 8% rate. And based on that, yeah, I have the 25% cost of sales. So I get all these numbers, cost of sales for each year from year one to five. And based on that, gross profit is nothing but sales minus cost of sales, which is yeah, difference between these two is 300K for year one. And similarly for the rest of the year, this is this minus this. And moving forward is your administrative expenses, which is say 20% of your sales. So here is your administrative expenses. Here is your calculated marketing expenses, which is 30% of your sales amount. And based on that, your net profit is gross profit minus all the cost, which is cost of sales plus 80,000 of that is administrative expenses and marketing expenses. So this 300K minus sum of these 1, 2, and 3. So that gives me 100K as the net profit. And then my total net profit is nothing but sum of all these 5 years of net profit. So that is, yeah, 586,000. And my initial investment is just given 200, $2 million to start with. And based on this, yeah, the calculation, so it's my ROI, which is return on investment, is 29%. Yeah. So these are some of the estimates I have starting from year one. I'm expecting 40,000 units to be sold, sale price of this. Annual sales growth is 8%, and these are the other information given. And suppose I used a very conservative information, and for 5 years, within 5 years, I expect a ROI of 29%. So suppose in this case, I want to use goal seek, or I want to do some more trial and error and estimation, and I want this ROI to be 29%. Yeah, sorry, 40%. So currently, based on all the assumptions I have, it is 29%. And suppose I want it to be 40%. Yeah. One more important piece of information is you see like all the input over here is based on the basic input that is given, which is the simplified version of the all the financial input that we have collected. And these are just multiplications we came up with. So first one is sales is nothing but B2, that is sales number of units multiplied by sale price. Similarly, the same thing for, sorry, escape year two. Yeah, I'm doing 1 plus, yeah, this part, which is like, yeah, annual growth rate, I'm increasing by 8%. The same thing over here, this plus 8%, same thing over here is plus 8%. Similarly, all these are based on the formulas I've used. So all these numbers entities you are seeing are all interconnected. And if I change one number over here, anywhere over here, say if I change this to 50,000, you can see all the numbers over here in the table will change because all these are based on calculations. These are interconnected. So I'm just yeah, playing around. I put 50,000 as sales unit and change. You can see everything is based on calculation. So everything changed over here. Yeah. So that is very important to know. And when you run these kind of analysis, what if analysis, and dry your profit and loss statements, this is very important to know that all these numbers should be, you should be using a formula. So again, coming back to our main topic about how to use what if analysis and goal seek. And yeah, based on the current ROI, if I want my ROI to be 40%, how should I approach? Yeah. So by now you should have known that, our expected this ROI cell is 40%. And there are few things that we have to change and few things we have to keep constant. So let's go to the goal seek. And the very first one is I'm going to select, yeah, my set cell as this one. I'm going back, and well, I want this value to be 40%. And by changing the cell, yeah. So again, one more important assumption to keep in mind is, yeah, the very first thing I'm going to try is, again, my initial investment, I'm going to keep it the same. Sales per unit in a year, I'm going to keep the same. Growth, I'm just using some yeah, standard market numbers. So 8% sounds good for a good company that has a good strategy, good product line, and good market size. And usually even the, yeah, like uh, the cost of sales, administrative expenses, marketing expenses, usually these are the right numbers. So together they are anywhere from like 70 to 80%. So this looks right to me. So now the only one thing that I can change at very first is sales price. So suppose let's try and play around with the sale price. Yeah. So I'm yeah, going here and selecting sales price and coming back, and I'll click OK. Yeah. So eventually what I'm trying to do is I want to know, to achieve a ROI of 40%, what should be my sales price? Yeah, that's the main question we are trying to solve. Yeah. So I'm going to click OK. You can see it did some iterations, and coming back, it is telling me, oops, sorry, it's not 4,000. Yeah, I think it took a couple numbers bigger, so I'm doing Control Z. So yeah, sorry, going back. Anyways, we were like almost correct, only it was a number that was different. So let's go here. I'm going to put this as my 40% as the value. And I'm going to say, I'm going to change this sale price as this much and say, okay. Oops, okay, now I know what the problem is. We should be putting 0.4. Yeah. Control C, going back, goal seek, B19 selected correctly. Here I'll put 0.4. Yeah, because it show this the unit here is percentage, so it will take 40% as a percentage. And the cell I'm trying to change is my sale price, and click OK. So awesome. Yeah, this is exactly what I wanted. You can see it run through, all the numbers have changed, and I've achieved a ROI of 40%. Everything else remaining the sale. I need to increase my sales price from $10 to $13.6. Yeah. So that's the very first thing to check. Yeah. So that completes this like one of the practice, one iteration where I want to set a ROI, and with respect to sales price, what should I do? Again, if I want to keep the sale price as the same, and if I want to change the sales growth year on year, let's try it out using the what if analysis goal seek. I'm going here for the set cell. Still going to use ROI over here. And here again, I want a value of 0.440%. By changing the cell, I'll select B3. I'm going to do this and change. Awesome. Yeah. So this tells me another story. Everything else remains the same. In order for me to achieve a ROI of 40%, I need my sales growth to be 24%. Yeah. So from 8%, it needs to be 24%. It looks extremely high. Like, yeah, shooting up from 8% to 24% is a big challenge. But again, that's good to know information based on the what if analysis. And here also, again, within few clicks, knowing what I'm doing, knowing what the importance and how to run this what if analysis goal seek. I quickly played around, and I played with two different scenarios, whether do I need to change the sale price from $10 to 13.6, or if I have to change the sale growth year on year, what it should be. Yeah. So again, the first one looks feasible for me, is like, yeah, if I increase the price from $10 to 13.6, which is almost I'll say 36% increase, that is feasible, versus if I have to increase the sale, I have to increase it by from 8% to 24%, which is 300 times, three times. Yeah, so 3 into 8% is 24. So to increase the sale annually by 3 times, which is very difficult. Yeah, usually for any business based on all the historical data. Yeah. So this is another thing I played. Coming back, suppose I have to play around with marketing expenses. Yeah. So again, this looks like the original scenario we started at. So again, I will go to the what if analysis. I will say goal C. The very first I'll select is, yeah, this is the correct one. And I'll set the value as 0.4. And by changing the cell, uh, this B7, let's see, everything looks right over here. I'm going to click OK. Awesome. So in order for me to achieve a ROI of 40%, keeping initial investment the same, sales unit per year, 8% year-on-year sale growth, price of this, my marketing expenses must change from almost 35% to 21%. Yeah, so I need to reduce. But again, that doesn't go well with the sale, because marketing is one of the important department. So if you significantly reduce it, it might not give you the right results. Yeah. So again, this is another third scenario we played around. So again, this is the importance of goal seek. Yeah. With this, we conclude this part of the lecture as well. Thank you so much for your attention and focus. Dear students, welcome back. And now you can see that we have a very simple scenario stated in this table, which you have already solved a few minutes ago. So this is the scenario about the project. We have some investment values over here stated in going cash flow 50,000 and then generating annual cash flow of 20,000 for the next 4 years. And then we also learned about some thing called as discount factor. And based on that, these are the net present values for year 1, year 2, year 3, year and 4. And eventually at the end of 4th year, this is what's the cumulative net present value is. So suppose, and again, these are based on assumptions and maybe some real world numbers. Yeah, based on, whatever assumptions, yeah, data is available for with respect to discount factor, cash flows, and so on. You've done your best. Oftentimes, management is also interested in knowing what if some of your assumptions change. So, for example, suppose you have assumed a discount factor of 10%. Again, this number is always subject to change based on how the market is progressing. So this could be 11%, 12%, 13%, 14%, 15, 16, 17, 18. So for like as time goes on, year 1, year 2, as your business proceeds, and if these numbers change, what will be the effect on the net present value? You should know and get an estimate. So in case there is a red flag, your management can bring it up and take necessary actions. So yeah, let's move forward and create another scenarios here. So again, I'm scrolling a bit down. And again, this time I'm using this third data sheet in our this file S20 dash financial what if analysis. So I'm going to this third sheet, that is data table, and I'm scrolling down, and here I have created here this net present value at rate. So the initial one we used is 10%. So suppose I want to know if it changes to 11%, 11.5%, 12, 12.5, 13, 13.5, and so on. And these could be, there could be hundreds of values over here. So one thing is you can run trial and error. So for example, if I want for 11%, I can put this number 11% and I'll get a number over here, and I can, yeah, say this equals to this, or yeah, I can copy and paste the number itself, and I can do the same thing for 11.5 and so on. But again, if I have hundreds of columns or cells like these, it will take me a long time. So this is where a very important feature in Excel comes into picture. So it's called data table. So Excel, yeah, thanks to Excel, it is created this very, very important, amazing feature that simplifies the life of lots of or most of the financial guys who run these kind of reports day in and day out. So yeah, here is the report. We will be running data table. In order for us to start, the first one is you have to set the target value. Yeah. So again, I will go back and change where we were at. So let's change this to 10%. That gives me 13. Yeah, 13,397.31. So the very first is I want to set a target value. Yeah. So I'm setting this as equals to this value over here. The next part is I'm going to select all of these from cell D12 until cell E31. Then I will go to what if analysis, select data table. Now there is this small window that has popped up. So Excel is asking me what are the row input cells. Yeah. So again, I have to make sure the very input on my right hand side top should be my target value. These are already selected, and everything below this is my projected discount rate which I have entered, which are numbers. And again, I can go to several level of precisions. I can say 11.1, 11.2, 11.3, and so on. And I can have hundreds and even literally thousands. That doesn't matter as long as I've selected, and as long as I'm selecting these, making these inputs correctly, it's all good. So that's my row input. So I will leave this since I've selected all these, I'll leave this blank and I'll go to the next one, column input cell. Yeah. So here, I want you guys to pay attention. So here it is telling me what is the column input that I need to change so that I can use these numbers, and I will get the projected net present value based on these numbers. That is the discount rate, updated discount rates. So for that, I will select this D3. Yeah, so cell D3, and I'll make sure I'm locking it and I'm selecting it, and everything looks correct to me. I've selected all of these, so I'm going to select OK. So then within, I would say, fraction of second, Excel did the calculations and it is telling me that using these assumptions, that is, yeah, initial investment of this at the start of the business, uh, at variable discount rates, and this is the at these standard cash flow inflow on, from year 1 to 4. If my market condition change, yeah, so these are subject to change. My market condition change and my discount factor also is affected. So based on that, if these change to anywhere over here, what will be the effect on my net present value? I'm getting these values. Yeah, and again I can do a cross check over here as well. So again, for 12%, it's telling me it's 10,746. I can try putting in 12 over here, and again that's the exact number I got, 10,746. I'll do Control Z. Suppose if I want to check at say 19.5, am I getting to, yeah, 2269? So I'll say 19.5. So yeah, 2269 is the number I'm getting. So you can see, like, instead of doing a trial and error, yeah, Excel has this beautiful function called as what. Oh, sorry, accidentally pressed that. Yeah, a beautiful function, data table, where I can, yeah, make the right, yeah, press set all my cells in the right tabular format and make the selections and run, and within fraction of seconds I'll get this analysis. And this is one of a very important analysis that your management often wants to see, especially if it is investing in several long-term project, medium-term, long-term projects, and so on, or any sudden expected in market conditions like a recession, low sale, some big catastrophic event like a tsunami came in, or like there is an earthquake or there is a war. Yeah, like the assumptions can change and these numbers can be changed. So these are some numbers that your management will be interested in knowing. So this is how we use our data table function in Excel. Yeah, so thanks to Excel for creating such an amazing feature. Within a fraction of a second, you get all the analysis done.